Hello and welcome to today's Tax in 10 topic, pre-year-end corporation tax considerations. This podcast gives some pointers as you approach your accounts and corporation tax year-end. This is a high-level aid memoir only, and if necessary, always seek specialist advice specific to your circumstances. This has been recorded immediately after the December 2019 election. Ideally, you should be considering tax matters a month or so prior to the year-end. So here's our list of things to consider. Number 1, tax rates. It is now likely that the tax rate will stay at 19% instead of reducing to 17% in April 2020 as previously thought. Whilst current tax rates won't change, deferred tax calculations might, as they may have been prepared using the anticipated 17% rate. This shouldn't affect what you pay to HMRC, but may change the provision and tax charge in the accounts, and thus available profit and loss reserves. Certainly one to discuss with your auditors. Number 2, timing of income and expenditure. Most accruals are allowed for corporation tax purposes. Here are a few tax-specific areas to flag up. Bonuses or salaries must be paid within 9 months of the year end. If the payment is delayed after that, the accrual will only be allowed at the point of payment. Similarly, employers' pension contributions will only get the corporation tax deduction on a paid basis. For salary sacrifice schemes, potentially all sacrificed amounts accrued become employer amounts. Additionally, for one-off pension payments in excess of $500,000, there are special spreading rules which limit the amount of corporation tax deduction in any 1 year. Finally, there are also late paid interest rules, e.g. interest to a UK individual is only allowed on a paid basis. Number 3, purchasing of assets, capital allowances. Capital allowances pools. For qualifying plant and machinery, there are 2 pools. The main pool for plant and machinery at an 18% reducing balance. The special rate pool at a 6% reducing balance for certain integral features in a building, such as lifts, air conditioning and electrical systems. The special rate pool is also for long life assets and cars with emissions above a certain threshold. The annual investment allowance, or AIA. Instead of a reducing balance, the AIA means 100% of the qualifying plant and machinery expenditure may be written off for tax purposes when incurred. From 1 January 2019 to 31st December 2020, the AIA is set at £1 million of qualifying expenditure per accounting year and prorated accordingly for shorter periods, and this should cover most capital expenditure in a period. If you exceed the AIA in a period, consider a short life asset election for any items which have a predicted life of less than 8 years and will have no residual value at the end. Rather than placing these assets in the pool, the election tracks these items separately. This could mean, for example, that if an item is scrapped after 4 years, the unused portion of the capital allowances can be claimed as a balancing allowance. This cannot be done if items are in the main pool. R&D allowances. If you are undertaking qualifying R&D and have expenditure on building new labs, then the building costs may qualify for 100% R&D allowances. All the costs get immediate tax relief. Structure and buildings allowances. This is a flat rate of 2% a year for up to 50 years on the eligible costs of building, converting or renovating non-residential structures or buildings that have been brought into qualifying commercial use. Number 4, disposal of assets. Companies pay corporation tax on any capital gains, so prior to the year end it is worth considering if there are any timing matters. Practical steps include, depending on what you are selling, the availability of the substantial shareholding exemption for disposal of shares, deferring gains on relevant assets, e.g. land used for the trade, through rollover relief, moving gains around the group in a group situation, and consider brought forward capital losses. Number 5, innovation and creative industry reliefs. At the year end, check for the availability of government innovation incentives, such as R&D tax relief or patent box. There are also a suite of 8 creative industry reliefs, including video games, orchestra, theatre, film, museum and galleries exhibitions, children's TV, animation and high-end television. These can reduce a tax bill or get cash back for a loss-making company. R&D tax relief can result in loss-making companies getting a refund of up to approximately 1/3 of qualifying expenditure. A restriction is being introduced with effect from 1 April 2020 on the amount of refund for SMEs, which will cap the refund at 3 times the company's total PAYE and NIC bill. Number 6, losses. For a loss in the period, a standalone company may carry back a loss for 1 year after extinguishing this year's taxable profits, carry the taxable loss forward. The rules for this change with effect from 1 April 2017, so that losses carried forward may be used against broadly all profits and not just future trading profits, as was the case prior to the 1st of April 2017. Groups may also surrender the losses to another profitable UK company in the group. The new post-April 2017 rules also mean that carry-forward losses may be surrendered for group relief. There is a restriction, however, in the new rules. If taxable profits in any 1 year exceed 5 million, then brought forward losses above that amount will only relieve 50% of the taxable profits in any given year. The 5 million allowance does not get carried forward and is reset each year. Number 7, brief considerations for owner-managed businesses. Check the availability and eligibility for entrepreneurs relief and that shareholding requirements continue to be satisfied. Entrepreneurs relief is currently under scrutiny by the government and the topic of another of these podcasts. Also check the status of any loans from the company to shareholders. Anti-avoidance legislation could mean companies must pay Section 455 tax at 32.5% of the balance outstanding at the year end if they are not cleared within a certain time frame. Number 8, brief considerations for companies and groups or trading internationally. Consider cross-border interest in payments and withholding tax. If you are borrowing from overseas and make interest payments, check that you have applied for the appropriate treaty or EU clearance or have been withholding income tax at the appropriate rates. Most interest payments to overseas companies is tax deductible on an accrued basis, but to certain countries late paid interest rules apply, so no deduction until paid. There is a list of the relevant countries on the HMRC website. Royalties. A similar review should also be undertaken for any royalty payments made to overseas entities. A final word about very large groups. If your company in the UK, however small, is part of a multinational group where turnover exceeds 750 million euros, you have a duty to notify HMRC before your year end about the ultimate parent entity location and where the country-by-country report is being filed. There is also a requirement to publish the company or group's tax strategy on your website or update it prior to the year end. And that is it. This is by no means an exhaustive list, just some ideas for you to consider in the month before your year end, and if necessary to discuss with your tax advisor. Thank you for listening, and please send us any feedback.